Define a derivative and distinguish between exchange-traded and over-the-counter derivatives. A derivative instrument is a security whose value is derived from the performance of an underlying asset or the outcome of an event. The party who buys the contract is called the long. The party selling or writing the contract is called the short. Derivative contracts are traded in one of two ways: exchange-traded or over-the-counter, OTC. Exchange-traded derivatives are traded through a regulated central exchange called a clearinghouse, who sits between trading partners. There's a few points to note about exchange-traded contracts. First, contracts which are traded through a regulated exchange are standardized. This means that the terms and conditions of the contract are set and defined. It's not customized each time a trade is done. Second, each party posts collateral in cash to a margin account with the exchange, and every day the change in value of the contract is settled. This is called marking to market. Because contracts are settled daily and collateral is posted and controlled by the exchange, these contracts are effectively free from default risk. Some examples of derivatives which are traded through an exchange are futures and equity options. OTC contracts work differently. Now we have no clearinghouse. Parties involved in a transaction deal directly with each other and create a custom contract specific to that deal. Because there is no margin account or a daily mark to market, there is some default risk in dealing with OTC derivatives. Some examples of derivatives trading via OTC are forwards and bond options. Contrast forward commitments with contingent claims. When we talk about forward commitments and contingent claims, the key phrase to be aware of is payoff entitlements. A forward commitment is an obligation to buy or sell an asset or make a payment in the future. Forwards, futures, and swaps are some main examples of forward commitments. A contingent claim, on the other hand, is a payoff that may arise dependent on some particular event happening in the future. It is the right of one party to demand a payment if the future situation is favorable to them. Options and credit derivatives are examples of contingent claims, seeing as they give the holder the choice to exercise the claim. What's interesting is that a combination of contingent claims in a portfolio can result in a forward commitment, such as when two options can be combined to replicate the payoff of a forward contract. Define forward contracts, future contracts, options, calls and puts, swaps, and credit derivatives, and compare their basic characteristics. Okay, let's just break down what this LOS is asking us to do. We need to define and compare forwards, futures, swaps, options, and credit derivatives. The first thing we can do is break this list down into two distinct groups. Forwards, futures, and swaps are referred to as forward commitments. Options and credit derivatives are referred to as contingent claims. In this video, we're going to talk about forward commitments. In the next, we'll look at the contingent claims. A forward contract is a commitment to a transaction that will happen in the future. The details of the agreement for a forward are custom to a particular deal and agreed between the two parties at the beginning. Neither party is liable for any cost up front because the contract isn't settled until the end of the term. No cash or asset changes hands until the settlement date. Forwards are often used to lock in prices at the beginning of a period to remove any uncertainty and eliminate risk. Since they are customizable contracts, they are ideal for building a hedge. Settlement of forwards can happen in cash, whereby the losing party pays cash to the winning party, or delivery, whereby a long party expects to actually physically receive the item they are contracted to buy. Cash-settled forward contracts are called non-deliverable forwards, or NDFs. Okay, before we move on, let's quickly go back over this idea of a hedge. Here we have two market participants. Both are currently holding an equity position with a volatile future ahead. One of them is happy to continue holding their position into the next period because they believe market turmoil will subside and this company will come out stronger. The other has decided to hedge their position by selling it into the forward market. Now be careful with the wording here. By sell into the forward market, I don't mean that the asset is sold. This means that they have booked a contract obligating them to sell or settle a sell trade in cash in the future. The key here is that at the end of the term, the price that the hedged party can sell at is fixed in their forward contract. They now have removed their risk exposure. The unhedged party, though, is exposed to the movement of the market. If it moves higher, they will take the profit. If it drops, they take the loss. A futures contract is a standardized and heavily regulated form of forward contract. In this case, the terms and conditions of the contract have been thoroughly designed to cover one particular set of features: a particular kind of underlying, a particular amount of underlying, a defined settlement date in the future, exact points of delivery. Every detail has been drawn up by the regulatory authority, and there is no facility to have them altered. Futures are generally exchange traded, which differs from the OTC traded forwards. As we have discussed previously, this brings a clearinghouse into play, with margin accounts and a daily mark to market. Okay, so futures are standardized and generally exchange traded. We have two more terms associated with futures that we need to be aware of: price limits and open interest. Futures contracts often have price limits to halt trading when price has moved significantly away from the previous day's closing price. Limit up at a level equal to yesterday's close times 1 plus the percentage allowed change. Limit down at a level equal to yesterday's close divided by 1 plus the percentage change allowed. Limit up means that trading in the market has taken the price of a futures contract up to the upper limit. Trading is halted until participants can agree a price inside the allowable range for that day. Limit down means that the price has fallen to the lower boundary. When trading is halted because a price has reached a boundary, it's called locked limit. One final term that is of significant value here is open interest. Open interest is the number of futures positions which at the end of a trading day are still open. These positions are a combined pair of long and short, which were opened but have not yet been closed. One party can sell out of a position to another party, but that will keep the future open, as there is still a long and a short. Open interest is a widely used measure of liquidity, which indicates that we should be able to see a narrow bid-ask spread for that contract. Technical analysts also use changes in open interest to gauge trend continuation or trend breakout. A swap is a derivative instrument obligating opposing parties to exchange a series of future cash flows. One common form of swap is a fixed for floating contract. In this case, one party agrees to pay some fixed rate of interest while the other pays a floating rate. Contracts like this are usually settled by one party paying out rather than both. The difference in the rates is assessed and one side becomes liable. In the first period shown here, the floating rate is lower than the fixed rate, so the fixed rate payer will pay the difference in rate to the floating rate payer. In the second period, the floating rate is higher than the fixed rate, so the floating rate payer will pay the difference to the fixed rate payer.